Welcome to the second state and local tax session, state and local tax headline news update. This session will focus on the state and local tax issues that our clients have had to keep an eye on during 2021. So I'm Jim Bartek, partner market leader of state and local tax, and I'll be moderating this session with some of the top minds in the state and local tax field. With me is Jason Rosenberg, senior manager and state and local income tax specialist. Jason has over 12 years state and local income tax experience, helping companies identify state and local tax opportunities, manage risk, and deal with issues such as sourcing of revenues for income tax purposes, pass-through entity taxes, remote workers, planning, and other compliance issues in all industries. Also with me is Lejdi McNair, principal and Withum's sales and use tax team leader. Lejdi has over 15 years experience focusing on sales and use taxes and has been leading many companies from all industries to comply with the new economic nexus compliance requirements throughout the country. And Jonathan Weinberg is a senior manager also in state and local income tax, who has over 20 years assisting clients with issues such as mergers and acquisitions, residency, remote workers, nexus, and sourcing. Jonathan also helps clients defend audits, including corporations and individuals. Okay, so during this session, we'll examine the latest developments in state and local tax. Jason will cover the changing landscape of pass-through entity taxes, why these laws were created, and how they developed over the past few years. Then Jonathan and Jason will cover expansion of income taxes related to Public Law E6272, including the history and some new MTC, Multi-State Tax Commission, guidance. Jonathan will then cover state and local implications of mobile workforces, as many companies have shifted to remote workforces during the pandemic. And then Lejdi will discuss what we're seeing on the sales tax front with regard to Wayfair and how it's affected companies 3 years later. Then we'll go around the horn for a few minutes to discuss potential state and local developments that we could see in 2022. Next slide, please. So now I'll turn it over to Jason, and he'll discuss the national landscape of pass-through entity taxes.
Great, thanks, Jim. There have been significant state and local tax developments this year, as Jim has alluded to, that have made the news. And as we embark today, we're going to kick off with a topic that's impacted almost every business structured as a pass-through entity. So let's look at the next slide. So over the past 3 years, we've seen a large number of states enact pass-through entity taxes, or what we refer to today as PTEs, with most of these laws being enacted just in the last 12 months. So how did we get here? As many of us know, the TCJA, or the Trump tax law, imposed a $10,000 limitation on the amount of state and local tax, SALT, that individuals may deduct for federal income tax. As soon as SALT cap became law, many states across the nation started to look for workarounds to mitigate the impact of this limitation. So the state started to respond by devising legislation to overcome the SALT limitation by passing various workarounds. Some of the earlier SALT workarounds that we've seen to date include travel deductions, payroll tax expenses, and then later with the pass-through entity tax. Many of these earlier SALT workarounds had shortcomings, but states started finding more success and traction with PTEs across the business community and with regulators. There were a few early adopters which helped transcend this new area of state tax. So post-TCJA, Connecticut was the first state to enact a workaround with a mandatory PTE tax. And New Jersey was one of the first of this handful of states to pass an elective tax version, which many of these states like New York and others used as a starting point in devising their own PTE legislation that have been enacted in the recent months. So by summer 2020, there were only a handful of states that have enacted these PTE taxes. Then in November 2020, 6 days after the presidential election, the IRS issued Notice 2020-75, explained that they intend to issue proposed regulations supporting the use of these PTE SALT workarounds. This was a taxpayer-friendly development that signaled to the states that individual owners or shareholders of a pass-through entity would not be limited the amount of SALT that they can deduct. So after the November IRS guidance, what we saw was a significant acceleration in states either enacting PTE taxes or at least considering it with proposed legislation. And as of today, there's probably about 20 or so states with a PTE tax.
Now, Jason, you mentioned that the IRS issued this Notice 2020-75, explaining they intend to issue the proposed regs. What's the status of those regs?
Yeah, great question. So These regulations haven't yet been issued to date. It's important to highlight that the IRS did issue their guidance 6 days after the presidential election, as I mentioned, which gives the appearance that this was rushed out of the door, considering that at the time it was likely seen a new administration would be taking over the reins. It still remains unclear if the Biden administration will either administratively or legislatively pull the rug on the SALT workaround, but it seems less likely each day as a new state enacts their own iteration of a PTE workaround. As you know, pulling back the IRS guidance would seem politically less likely, but it is an area that still needs to be monitored. So thanks, Jim. As we look at the next slide, the objective of the PTE is quite simple on the surface. Simply by imposing the tax at the entity level, the flow-through entity is able to deduct on its federal return state tax expense, thereby reducing the federal taxable income and its federal tax. Since the pass-through entity is now responsible for the tax, the entity would be allowed a full deduction for state and local tax, opposed to individual partners who would have been capped on their SALT deduction. In turn, the state provides the business owner a state tax credit or an income exclusion at the individual level to offset any double taxation. So at the end of the day, in essence, the state still collects the same revenue, but for federal tax purposes, this in turn keeps the federal SALT deduction subsidy that was in place that existed pre-TCJA. So if we look at the next slide, we're looking at this map. So before the SALT limitation in 2018, there are maybe a few states at best that had a pass-through entity tax on an income basis. And these were generally mandatory, not elective taxes. Here we can see as the summer of 2020, even a couple of years after the TCJA was enacted, there were maybe at best 6 to 7 states with a PTE tax. So what we're going to see in the next several slides, we're going to take a look at how rapidly since the summer of 2020, these PTEs have really been enacted. So looking at the next slide, you can see by April 2021, right, some months after the IRS issued 2020-75, in the Southeast states like Alabama, Arkansas, they enact PTE taxes, while we also see an uptick in a number of states starting to propose these taxes across the US. Looking at the next slide, in June, we can see more states joining the PTE club, with it spreading from east to west, with Idaho being the most western state enacting the tax. And if we look at the next slide, all right, by late August, additional states, again, are joining the club. You can see California, which was enacted the prior month. So we have more states joining the club. It's getting more and more green. If we look at the next slide, you can see, you know, as of today, going into November, right, we can see about 20 or so states now with the PTE tax legislation. And it wouldn't surprise us by the end of the year if we saw maybe around 25 or so states with a PTE tax. So the momentum of this is incredible. To see this map just completely fill in over even just the last 12 months or so has been unparalleled. So if we look at the next slide, so now that we know the benefits in terms of the risks, there are certainly some considerations that need to be taken into account before electing a PTE tax. So here's a snapshot of some of the primary risks that generally need to be considered with a PTE election. First, it's possible, as we mentioned, the Biden administration rescinds the workaround, but it would seem unlikely with about half the states now enacting a PTE tax, but something worth mentioning. Second, the biggest concern that needs to be front and center with any of the states with a PTE tax is the potential risk to the loss of the individual resident credit. By making a PTE election, a tax is now paid at the entity level opposed to the individual level, which may not be credible for non-residents of a PTE electing state. And as such, the loss of a credit may outweigh any benefits from making an election. So what's really important is modeling and analysis. It needs to include specific state review, taking into account state residency of the partners to determine the extent of the potential loss of any resident credits. Next, an equally important consideration when making an election is that in many states, the PTE tax is computed to the extent that there's sourced income in the state. As each state's PTE uses different mechanisms to compute state source income, the lack of presence in a state, such as customers or source sales, or lack of physical presence, such as an employee in the state, could result in a lesser benefit. So that needs to be taken into account. Also, another area that needs to be mentioned is cash flow timing issues. Some states with duplicate estimate payment requirements may still require an entity that makes the election to withhold on non-residents based on state source income, while also requiring estimated taxes for the pass-through entity, whereby when the return is filed, a refund would be issued for the duplicated payments. There may be also other risks, such if the entity is an investment partnership, right? There may be the question of federal deductibility. So these are all things that need to be considered when we're thinking about the PTE.
Now, Jason, can you give us a couple quick examples of what we're seeing and how states differ when it comes to computing state source income?
Good question, Jim. Yeah, I think if we just think about like the tri-state area here in the New York region, we see a perfect example of this up close. In New Jersey, the state's BATE or PTE equivalent, if that's elected, all flow-through entities use what is known as cost performance sourcing, even S corporations, which traditionally in New Jersey would use market-based sourcing. So by making this election, not only are taxpayers electing a PTE, but they're also in effect electing to use the cost performance sourcing for purposes of calculating the PTE tax. Meanwhile, if we look at New York, right, the election into the state's PTET carries over the entity sourcing rules that would otherwise be used, where a partnership would use cost performance sourcing and S corp would still use market-based sourcing. So this is just a taste of the many variables that we need to be considering when modeling out PTE elections. Now, if we look at the next slide, each state's PTE tax has their own unique rules and features, and we'll just briefly go through some of these that we see over and over again. First, is the election mandatory or elective? In most states, it's elective, but for example, in Connecticut, it's mandatory. Also, is the election revocable? In some states, like we see in New Jersey, there is the ability to revoke the election prior to the due date, but in other states like New York, it's completely irrevocable once the election is made. Second, with eligibility, depending on the makeup of the owners in the flow-through entity, not all businesses may be eligible to make the election, which we see this as an example in California as a restriction, where if a partner comprises of a partnership entity, the PTE becomes ineligible in making the election. Next, with computing the state taxable income, right, as we alluded to before, each state has its own unique rules to determine the allocation of income. Where in New York, though, one other thing to keep in mind, there could be a larger benefit just by having resident New York partners as part of the structure, which would not be a feature in New Jersey or some other states. So that's also important. Residency may also, in addition to state allocation, dictate the benefit, the extent of the benefit. And last, with the owner offset to prevent double state taxation, some states use a credit mechanism, while other states use an exclusion approach. And there could be unique rules that apply depending on the approach. For example, if a partnership has a partner in an S corp that is in New Jersey, that credit gets trapped. So it's important to be cognizant of some of these issues when modeling out potential PTE benefits. Now, if we look at the next slide, here we could see in this graphic, just to show you between mandatory and elective states, just kind of give you a taste of what the allocation is between the two. If we look at the next slide, here you can see just kind of on a chart level, right? New York takes the cake in the extent of the tax rate being one of the highest, exceeding 10%. And you can kind of see if there's a state that you're interested in electing and where it falls on the tax rate scheme. If we look at the next slide, here you can see with the owner offset, right? Do states use an exclusion approach or states use the credit approach? You can see it's kind of give or take 50-50 in terms of how the states categorize and provide that double offset, that double tax offset. Which one thing that's unique is that some of these states, when they do give you the credit, it's not dollar for dollar, it's a little bit less. You can see that in Massachusetts, you can see that in Connecticut, where they take a little bit of a haircut. It still will maybe very beneficial to, you know, go through with a PTE election in Massachusetts. But the thing is, just keep in mind that the state might be taking a little bit of a haircut under the credit mechanism. And if we look at the next slide, in terms of next steps, as we look to wrap this up, right, it's crucial that all the various factors are modeled out. As mentioned, a key consideration may be owner's state residency, but there may be potential structuring strategies in order to maximize the federal benefit to owners. So again, Modeling out all the facts is vital in making any PT election decisions.
Okay, excellent. Thanks, Jason. Obviously, it's important to make sure you model this out, make sure it makes sense to make these elections in the various states. So with that said, so let's go to the next slide, and we'll be discussing expansion of the income tax nexus via Public Law 8672. So Jonathan, you want to take that?
Yes, let's go to the next slide, please. And so what is 86272? So 86272 is a federal law enacted in 1959 that limits states' ability to levy net income taxes. As a federal law, it applies to every state that imposes a net income tax, the same as every other federal law. And here, you know, that 86272 was enacted in 1959 when cars still had fins, and now we're seeing the world change around it and is losing its effectiveness. So let's move to the next slide. So what is a summary of 86272? Public Law 86272 says that a state may not impose a tax based off of net income when a taxpayer's sole connection to the state is a solicitation for sale of tangible personal property and the order is accepted and fulfilled from outside of the state. So this law was really enacted to protect the door-to-door vacuum cleaner salesman in a time where people still made door-to-door sales and the economy of America was making things out of metal and wood. Obviously, the economy of the world has changed, and of course, 86272 is therefore losing its effectiveness. So let's move to the next slide. So again, there have been many historic limitations to Public Law 86272. The first one is that you needed to be dealing in tangible personal property. So taxpayers selling anything other than tangible personal property will prevent that taxpayer from claiming Public Law 86272 protection. So examples of transactions that go beyond the sale of tangible personal property include services of any type, including installation, maintenance, and training. And it generally doesn't matter if such services are rendered by an employee or an independent contractor. Performing any sort of services within the state or even just soliciting for sale services will eliminate your 86272 protection. Also intangibles and 86272 protection. Examples include licenses, franchises, and warranties. But in today's economy, every box comes bundled with an intangible. And you can't use the box without the intangible, and you can't use the intangible without the box. So if you think about the original John Deere used to be a dumb tractor. It is now very sophisticated software that rolls around in the dirt. And therefore, taxpayers are losing their ability to claim 86272 protection from bundling both tangibles and intangibles. Moving on to the next slide.
Yeah, and Jonathan, before we move on to the next slide, you mentioned that businesses also providing services would not be eligible for Public Law 86272. What are your thoughts about businesses that derive sales from both sales of tangible personal property and service revenues? Would they be able to claim Public Law 86272?
You know, every facts and circumstances is different, so it can be a very close question. But in general, if you are bundling services along with the sale of tangible property, that would eliminate your ability to claim it. I mean, we were discussing about a company that makes custom shelving. Well, if I just tell the company I want shelves that are 72 inches long, well, now I'm just buying tangible personal property. But if the company is going to advise me as to what my needs are and provide engineering and design services, and that's bundled in with a sale price, that probably is over the line and would prevent that company from claiming 86272 protection.
Yeah, absolutely. This could get complex pretty quickly.
Yes. So moving on to the next slide. So historic limitations, solicitation. So engaging in any activities that go beyond solicitation of state will prevent a taxpayer from claiming Public Law 86272 protection. Now, one of the most famous cases is Tic Tacs sending people around the country to make sure that all the Tic Tacs on display in every single store were still within their recommended sell-by date. And the state said, well, no, that's not soliciting. You are actually doing quality control inspections, and therefore you're going beyond 86272. So examples of activities that go beyond solicitation include repossessing property, accepting or fulfilling orders on the spot, including fulfilling orders out of samples, having employees in the state not engage in solicitation activities, And this leads right into the mobile workforce issues that we'll discuss in a few minutes, that having employees now moving around the country who are not involved in sales can be breaking your 86272 protection. And of course, maintaining property in the state, including consigned inventory, inventory held in the state by a marketplace facilitator, goods in process or raw materials, and returnable containers or pallets, which is one of my favorite ones. That one of my former clients was a brewer, and they lost their 86272 protection because they started selling beer in kegs. And the way the industry works is the brewer owns all the kegs. So they were owning returnable containers in all 50 states. So moving on to the next slide. So also, one of the other historic limitations to 86272 is 86272 only applies to taxes based off of net income. 86272 does not protect taxpayers from any other state taxes, including minimum taxes, gross receipts-based taxes, sales taxes, franchise taxes, or really anything that is not based off of net income, which is gross receipts minus deductions to get to a net income based number. If it's not a net income number, then it's not protected under 86272.
So now, Jonathan, you do a lot of mergers and acquisitions. This is a common issue that comes up quite a bit.
Absolutely. I mean, the number of clients that I see that think they can claim 86272 protection, and the number that can successfully claim 86272 protection are very different numbers. So then moving on to the next slide. So 86272, the MTC recently issued their second restatement on 86272. So who is the MTC? The MTC is an organization that represents state tax authorities. Their activities include recommending uniform laws, encouraging compliance, training and education, supporting states in tax litigation, advocating of state interests. They'll also do an MTC, a multi-state voluntary disclosure program. But the long and short is the MTC is not our friend. But they also do not have legal authority or administrative authority. All they have is persuasive authority. So, and from here, I'll turn it over to Jason to discuss the MTC's revisions to how 86272 should be applied in the internet age.
Perfect. Thanks, Jonathan. If we look at the next slide. So here you can see in this graphic the timeline of MTC's interpretation of 86272. As Jonathan mentioned, 86272 is enacted by Congress in the late 1950s, and in 1986, the MTC put out their original adoption, which is really just their interpretation of how the federal law applies from a state perspective. And you can see that the MTC revised and put out additional guidance throughout the years. And you can see in 1993, 1994, 2001 were the latest revisions. And then it's gone about 20 years since we've seen any revision. And you can imagine, given that the changes since the boom in the internet in the late 90s, early 2000s, significant changes have happened in the marketplace. So what happened was, and what we're going to be, why we're talking about this today, is if we look at the next slide, is that soon after Wayfair was decided, which is a sales tax case, the MTC launched a work group to examine the application of PL 86272, considering that, one, service providers without physical presence that conducts business remotely are generally subject to income tax, while at the same time, remote sellers of tangible goods may be immune to income tax, right? So we got that one issue to think about. And number two, remote sellers of tangible goods who are now generally subject to sales tax as a result of Wayfair, where remote sellers of tangible goods are generally immune from income tax. So because of all these disparities, the MTC formed this work group to address these contradictions and examine the federal law for remote sellers doing business through the internet. As there's been significant change, quote unquote, significant changes that have occurred during the past 2 decades in the economy and the way that business is conducted. In February 2020, about a year after commencing this initiative, the MTC released a proposed revised statement establishing that a business could lose PL 86272 protection based on routine interactions with customers through the internet. The proposed revised statement explains that as a general rule, when a business interacts with a customer via the business website or app, the business engages in an activity within the customer state, resulting in the loss of Public Law 86272. And on August 4th, 2021, the MTC voted to formally adopt the revision to the Statement of Information. Revisions to the statement include a new section on protected and unprotected activities for activities being conducted over the internet, among other clarifying changes. Although Wayfair did not interpret PL 86272, the revised statement, interestingly, references the case. So with that, let's go to the next slide. So here is the examples of protected activities under MTC's current restatement. So this is what's currently still protected. It says selling only tangible property via a website that only allows customers to search for products, read product descriptions, select items for purchase, choose delivery options, and pay for items. Number two, a protected activity includes placing a static FAQ on a web page. That is still an okay activity according to MTC. If we go to the next slide. Number three, placing cookies on the computer or devices of customers if the cookies are if they're purposely limited to the following. And so what they do is they differentiate the type of cookies to determine if it's protected or unprotected. And you can see here items like reminding customers that they have items in their online shopping cart is okay, storing customer information so they could avoid re-inputting it for each transaction is okay, and reminding customers what products they have considered in prior browsing sessions is okay according to the MTC. If we go to the next slide, now these are the activities that the MTC says is no longer okay for businesses conducting business, via the internet. And one would be providing post-sale assistance to customers via electronic chat or email. So according to the MTC, just simply by having a link to an email address for customer service, that activity alone may tarnish protection for 86272. So it's very, very narrow. Number two, soliciting and or receiving online applications for branded credit cards. Three, the company's website invites individuals to apply for non-sales related job openings, fill out electronic application, and upload a resume. So by participating in this activity, and it's not clear if those jobs are limited to that one location, if that's going to tarnish it, or just by doing this activity in general would tarnish 86272 across the 50 states. It's not entirely clear, but what it does say is that this activity could be troublesome. And number four, placing cookies on the computer devices of customers if the cookies are used to gather information to adjust production schedules, manage inventories, or develop new products or offer new products for sale. These are going to be result in the loss of 86272. Now, if we go to the next slide. Number five, the business remotely fixes or upgrades products by transmitting code or other electronic instructions to those via the internet. That impacts a lot of our clients because a lot of our clients who sell technology goods, hardware, right? They might be providing service updates through patches via the internet, and that, according to the MTC, would tarnish 86272. And six, the business offers or sells extended warranty plans via its website. And seven, the business contacts with in-state customers to stream video and music to electronic devices for a charge. At the end of the day, these are just examples to keep in mind. But what the state is getting at is, or what the MTC is getting at, is that any business doing, conducting activities via the internet needs to be concerned that their protection may be tarnished as a result. And it's super important to keep an eye out on this, as this is a fast-moving development that we expect to see over the next couple of years. So if we look at the next slide. Now, question is, right, will the states adopt this? How will they incorporate it into their statute, their regulations, their guidance? As Jonathan mentioned, the MTC is not a governing or legislative body and does not have authoritative power, but states may adopt it in their guidance in whole or part. The statement is intended to serve as general guidance to taxpayers and to provide notice as to how supporting states will apply this statute. A supporting state is a state that adopts or otherwise expressly indicates support for the revised MTC statement by legislation, regulation, or other administrative action. Other states also may adopt or otherwise indicate support for sections of the statement. The question is, will taxpayers challenge? I think that's a given. They will. Question is, right, in the coming years, how will those legal challenges develop? That's something to be seen and something to monitor. With apportionment implications, one important consideration is going to be throwback. So, we need to keep in mind all the different implications and continue to monitor MTC and how this might impact businesses as states come out with forthcoming guidance over the months and years to come.
Jason, this sounds like a lot of negatives of the MTC and watering down the protection and exposing more businesses to Nexus than ever before. Are there any positives from this adoption?
Yeah, so as I just mentioned with throwback real briefly, right, that's something that I should probably expand on, is that undoubtedly this is going to impact many businesses, but there could be some good that comes out of it, right? One example might be throwback for the purposes of computing apportionment. For states, if a business sells tangible goods and ships goods from their warehouse, let's say in Illinois, and Illinois is a state that applies throwback when goods are shipped to a state where the business is not taxable, this MTC restatement may provide support to seize throwback as if they're taxable in all these other, some of these other states, which sometimes if you're looking to lower your tax rate, like from a state like Illinois or California, to assert a lower rate and a lower effective tax rate across the 50 states, that might be a good thing that comes out of this. But of course, this is going to negatively impact a lot of businesses as well. We're advising clients to continue to monitor and see how states adopt this into their code, into their regulations, into their guidance, because right now the MTC has put out this guidance, but what we need to now do is kind of monitor and see how states interpret this guidance and employ it going on a going forward basis.
Okay, thanks, Jason. Okay, so with that, let me hand it over to Jonathan again for state tax implications of a mobile workforce.
So telecommuting. So right now we are into month 19 of what was supposed to be 6 weeks of temporary work from home. So COVID-19 has exacerbated all of these issues as offices were shut down and everyone was forced to work remotely and employees and workforces have scattered to the wind. A new focus has been put on telecommuting with regards to income and sales tax nexus, income tax apportionment, and state payroll withholding. moving right into the next slide. So telecommuting's impact on nexus. So in order to be subject to a taxpayer needs to have a minimum threshold contact with the state that is sufficient to establish the state's ability to impose a tax. From a sales tax perspective, a seller, once they have nexus, is obligated to register, collect, and remit sales tax on sales made within the state or collect exemption certificates. From an income tax perspective, that once you have those minimum connections, you're obligated to file income tax, gross receipts tax, net worth taxes. So types of nexus include physical presence nexus, economic nexus, and economic nexus includes both factor presence and doing business. That once you have employees within a state, you have physical presence nexus. And at that point, even if you're under these economic nexus thresholds, even if you've traditionally been underneath the economic nexus thresholds, now you do have sufficient connection with the state. So moving on to the next slide. So obviously when you have telecommuting employees, as a result of COVID, a handful of states have issued guidance that, well, if you have employees temporarily working remotely in the state due to an emergency declaration, that does not create nexus. But number one, many of those emergency declarations have either expired as of now or will expire in early 2022. And what we're seeing is that these temporary work arrangements where employees were going to work temporarily remotely have very much become permanent work arrangements where employees are either now working permanently from wherever they went, or companies are implementing policies like flex time or hybrid work arrangements where employees work from home some days and then they come in when they need to. Well, these employees may be creating nexus if they're continuing to work remotely after these emergency declarations, as well as if you are claiming 86272 protection in those states, having a remote employee in the state may end your 86272 protections in that state. So again, it's critical for businesses to consider their policies with respect to remote employees and what it does to their nexus footprint. So moving on to the next slide. So telecommuting also affects apportionment. So for income taxes, all income taxes need to be fairly apportioned. So states can only subject income derived from sources within the state to tax in the state. So to the extent that employees moving away from the office, it could affect your sales sourcing, as well as a payroll factor, and even the property factor, to the extent that employees have been given equipment, desks, computers, monitors, printers, what have you, to work remotely. All of those things could be moving the state apportionment around. So how do you determine how much income is taxable in one state versus another? So when you conduct business in multiple states, and all of a sudden, by having remote employees, you're conducting businesses in multiple states, all the taxable income must be divided amongst the states. So traditionally, states have often leveraged a model called UDIPA, which uses an equally weighted formula of property, payroll, and sales, where you look at the ratio of property, payroll, and sales in the state to everywhere. But at this point, almost every state has diverged from this and have super weighted the sales factor. So at this point, many states are using single factor sales, where the sole measure of apportionment is your sales in the state versus your sales compared to everywhere. But there's some other states that use triple weighted sales, double weighted sales. There are very few states that use straight 3-factor apportionment at this point. As well as states use different sourcing statutes, depending on whether you're selling an intangible versus tangible personal property and how they deal with that. So moving to the next slide. So here we have a summary chart on how the factors work. So you have your factor components, which would be payroll, sales, and property. It could just be sales. Then you can look at your sourcing methods. For tangible personal property, it's generally destination. For services and intangibles, you're using either market-based or cost of performance apportionment. But your cost of performance apportionment is pretty much tied back to your payroll, which is where you're doing the work. So again, depending on where your employees have moved and how that payroll is shifted, your cost of performance is shifting. To the extent that your property is moving, your payroll is moving, all of this is going to affect how you source your sales. Moving to the next slide. Okay, so telecommuting impacts on payroll taxes. So in addition to income taxes, sales taxes, employers have an obligation to withhold appropriately on their employees' compensation. So it's not just state income taxes, it's Social Security, unemployment, reemployment, any other sort of state social taxes. They have an obligation to withhold those. So as employees have gone remote, all of a sudden, employers need to start withholding in new states. So, and of course, employers need to rely on their employees to tell them where they're located and what their withholdings need to be through a state withholding certificate. So employers have been finding that employees have been negligent in updating their information in the system. And again, that causes some heartache where all of a sudden there needs to be catch-up payments and an employee is over withheld in one state and under withheld in another. So, when you look at residency and where an employee lives, the state where an employee principally lives has a primary tax authority over that individual's income. So if you're a resident of a state, that state is entitled to tax you on 100% of your income from whatever source derived. But if you work in a different state from where you live, that state is at least entitled to primarily tax you on your wages. But then you would claim a credit back in your home state for the taxes you pay to the state that you work. But then complications easily arise when there are reciprocal agreements between states and when there are Office of Convenience rules. So there are a handful of states out there that have reciprocal agreements. For instance, I'm a resident of Virginia. Virginia has reciprocal agreements with Pennsylvania, Maryland, and DC. So I can work in any of those states 100% of the time, and all of those states say just withhold in Virginia. because we're just going to only tax our own residents. But as soon as I work in North Carolina, I'm subject to withholding on that first day. So moving on.
Yeah, and Jonathan, I know we're running short on time, but so speaking with many businesses, they're subject to convenience of the employer rule. How many of these businesses are asking, are there any exceptions to the rule?
Right. So, a lot of states, or a handful of states, do have this convenience of the employer test, which says that if you're assigned to work in a jurisdiction, even if you don't work from that jurisdiction for your own convenience as opposed to your employer's necessity, you remain subject to tax in a place like New York. Ways that we've been addressing this are, well, if we are going to a remote work arrangement, let's make it clear that this is for the business's need and not the employee's convenience. So now it's not the employee coming to the employer and saying, may I work remotely? It's the employer telling the employee, go work remotely. That's one aspect. Another is that, at least in New York, the sense is that an employee needs 1 day in New York to kick this off. So if you can have an employee work remotely outside the state of New York for an entire year, they probably aren't subject to the Office of Convenience rule. But one day of work in New York, including coming to the office holiday party, could end that exception. So if you're going to think about doing an arrangement like that, you really have to make sure that the employee is never working in the state where they were theoretically assigned to. So moving on. So finally, we just have a quick map showing what states are the most friendly to mobile workers and their employers. There's really only 8 states that are, in theory, friendly to remote workers, where they say that someone who's working remotely in our state isn't subject to tax here until they hit 30 more in the state, until they hit $10,000 worth of wages derived from sources within the state. That they have thresholds that for make it easy to work a couple days in that state and not be subject to withholding. The overwhelming majority of states will wind up in that unfriendly bucket, where just a very limited number of work days in the state, or even one work day in the state, puts you in a position where you need to withhold on that employee. And as we see employees go off and live the van life and travel around the country and go to all the national parks, employers need to keep on top of that, because every single one of those remote work days, the employer needs to deal with a withholding issue.
Yeah, so with that being said, let's Lejdi, if you can give us a few minutes on Wayfair. What are we seeing? What issues are you seeing that are affecting our clients these days in Wayfair?
Yeah, thanks, Jen. It's great to be back and continue to discuss sales tax. While in the prior session, I focused more on the nexus creating activities, I wanted to discuss a little bit more on this session what happens when nexus is established. So obviously, a lot of the times I get questions from my clients assuming whether or not sales tax is an issue. The most shocking one is the not-for-profit. So a lot of my clients in the not-for-profit industry, they always think that sales tax is not one of those areas where they need to focus on. So we put a list of clients and niches and industry that are definitely impacted by Wayfair and also sales tax obligations. We spend a good majority of the time managing clients in this different type of industries. Obviously, the technology area and also the service area are the ones impacted the most. And the reason for that being is a lot of our clients are under the impression that a lot of what they're doing is not subject to sales tax. And we'll talk a little bit more about that and what does it really mean. So navigating a world of post-Wayfair. So with the Wayfair case, and obviously from the prior session, everyone is aware of what the Wayfair case stands for. But obviously, if historically, in order for a state to impose nexus requirements, the company had to be physically present in the state. That is no longer the case. Now, by mere fact of having over a certain amount of sales or transaction in the state, you have created nexus. So what does this mean for a lot of our clients? A lot of our clients have to actually consider nexus requirements. And where I spend the big majority of my time is looking into the client offerings and figuring out, is that subject to sales tax or not? So if you are in an industry where you're selling just regular changeover personal property, obviously that's subject to sales tax in most jurisdictions, and there's not really a lot of uncertainties there. There may be some questions and concerns whether or not you're selling maybe to an exempt entity, or you selling to manufacturers and such, and is there exemption certificate requirements. Where my clients are struggling the most truly is on the industries where there are some complexities in regards to taxability. A lot of my clients are in the technology space. So what that means is a lot of what they're selling, it's a variation or either or software as a service, data or information services. And sometimes it's just consulting service. A lot of my clients come to me and say, okay, Lejdi, you know, historically I always felt like SaaS is exempt. And I say, no, that's no longer the case. Obviously, if you are conducting business in California, yes, that is the case. But, you know, Northeast and most of our states, New York, Connecticut, Pennsylvania, Maryland nowadays, DC, that is no longer the case. So as part of the review that we do, we look into the taxability of product by reviewing the agreements and invoices, and it's super important to really truly understand what our clients are doing and understand the law and how it applies to them. So once we do a taxability study and, you know, it's decided the company has taxable sales, we go into this planning mode. And what I mean by that is we look into what should the next steps be for the company. Should the company register to go forward? Should the company consider doing a voluntary disclosure agreement? What is the true exposure here? Obviously, we have to take in consideration that there are about 60,000 different sales tax rates. And then the biggest part of the equation is, okay, now that you know what you have to do, what is the plan going forward? And what I mean by that is, okay, how should a company manage and handle sales taxes? And, you know, obviously sales tax rates, they're not handled, you know, easily available. They do need to be incorporated into a CRM system. So we do work with a lot of our clients to actually provide them with solutions that fit them best. But also we talk about compliance for some time or for a little bit. So, you know, figuring out whether you have nexus or not and whether your products are taxable or not, it's just the beginning and part of the puzzle. But also you need to consider going forward, what does this mean for company overall? And this is super, super important because obviously there are some major consequences and, you know, this is not an easy and cheap process. I have clients that are more in the marketplace facilitator world, and this is a big compliance burden for them. So super important to kind of think about what are some software tools that can help with the process, and also to keep in mind that software tool can't really provide the answers to all the questions, right? It's important for the company to understand, or for you guys to understand, that you should maybe perhaps talk to a professional and help you and guide you through this whole process. So as I mentioned with the compliance, it's a burdensome process. Obviously, there are monthly filings. There is no such thing as yearly filings. So most likely, if a company has nexus in every state, you're looking about 400 to 600 returns a year. So that's a big process to take on internally. Obviously, this is one of the post-Wayfair headaches that a lot of my clients have to consider looking into. There are obviously a lot of providers out there. Withum also provides this as a service offering. This will be a maintenance yearly cost that a company would have to incur. Also, what I've noticed is since 3 years of Wayfair has passed, there's been a lot of notices that my clients have gotten. And what I mean by that is originally when the Wayfair case happened, a lot of my clients, you know, were late in responding to the Wayfair. So waited a year or two to become compliant. And with that being said, a lot of states, once my clients decided to register, a lot of states have started reviewing their filing frequency and revenue and have decided to start sending out notices and audits. So I've noticed in a lot of audit notices coming out from the states, just looking at the revenue and the returns that have been, or compliance that has been filed the last year or 2 years. And so what that means for a lot of my clients is that now they do have this past exposure. that perhaps they weren't considering.
What I wanted to do is just ask and go to one more slide, is quickly go around the horn and in 15 to 30 seconds, Jason, tell me, what do you think will be the hot topics in 2022?
Yeah, as we look to turn the page at 2021 and look to 2022, the one topic I'd probably say is gross receipts. Handful of these states have enacted this kind of tax over the years, like what we see in Ohio, Nevada, Texas, Washington, more recently as of 2020 in Oregon. But I expect to see more of these, as those, these kind of taxes have lower rates, but without any expense being taken into account with the tax base. These taxes often collect significant revenue. And we often see lost companies that aren't traditionally subject to business taxes be subject to business taxes. So I'd go with gross receipts as being 2022.
Okay, thank you, Jason. Jonathan, your thoughts?
I think we're going to see states enact worldwide combined reporting requirements, either as an election or mandatory. I also think we're going to see some constitutional challenges to both single factor sales apportionment as well as office of convenience.
Okay, excellent. Thanks, Jonathan. And Lejdi, your thoughts on the sales tax side?
Yeah, I would guess that the states are going to continuously start enforcing the economic and nexus rules. So we'll see a lot more mini audits and notices. So be on the lookout, and please don't ignore them. So whenever they come around, just don't put them in a drawer and never look at them again. But yeah.
Excellent. Thanks, everybody. Please make sure you consider these important state and local tax issues that we discussed today. Again, monitor your 86272, the laws and how the states are looking at them. PTE taxes, make sure you model. Make sure you don't just enact it. Make sure you're looking at whether it makes sense. Remote workers, important for sales tax and income tax as well, and gross receipts, and as well as taxable services, economic nexus and taxable services for sales tax purposes. Again, as new services are offered, you're going to have to make sure you understand how you're marketing them on the web page, and also how you're mapping them for sales tax purposes. Again, thanks for everybody for joining us, and we'll speak to you soon.